How the commercial real estate collapse could break America. Picture this. Gateway 1, a 50-story glass tower in the heart of St. Louis, Missouri. In 2019, it was appraised at $205 million. Investors were fighting for a slice. Corner offices, concierge lobbies, parking garages with 4-year waiting lists. Now picture it today. The building sold in 2024 for $3.6 million. That's not a typo. 98 cents on the dollar gone. An asset that once anchored a city's tax base, its pension funds, its very identity, disposed of like a garage sale item. St. Louis isn't alone. In San Francisco's financial district, towers that commanded $1,000 per square foot in 2019 are trading at $150. In Chicago's Loop, vacancy rates have crept past 25%. In Houston, in Atlanta, in Midtown Manhattan, the same story with different zip codes. This is not a correction. This is not a dip. This is structural collapse, and you're going to want to understand it before it reaches your front door. The American commercial real estate market sits on roughly $20 trillion in total assets. Of that, approximately $1.5 trillion in loans are coming due between now and 2026. Most of those loans were written when interest rates hovered near zero. They're now being rolled over or failing to roll over at rates 3 or sometimes 5 times higher. So here's the question that every pension manager, every regional bank regulator, and every American with a savings account should be asking. Who is left holding the bag? To understand the gears of this machine before they grind to a halt, you'll want to stay tuned to this channel. Because what comes next is not Wall Street speculation, it's mathematical inevitability. Let's talk about how commercial real estate actually works, because this isn't the mortgage on your house. This is a different beast with a different set of rules, and those rules are currently eating people alive. When a developer builds or buys a commercial property, an office tower, a retail complex, a hotel, they typically finance it with a 5 or 10-year loan, not a 30-year fixed rate like a family home. 5 to 10 years, then they refinance. In theory, the property has appreciated, rents have gone up, and a new loan is easy to get at similar or better terms. That's the theory. Here's the reality. Between 2012 and 2021, interest rates were at historic lows. The Fed kept borrowing cheap to juice the economy. So developers borrowed aggressively. They loaded up properties with debt at 3%, 3.5%, sometimes even lower. The math worked beautifully. Low cost of capital, rising valuations, fat returns. Then the Fed hiked, fast and hard. 11 rate increases between March 2022 and July 2023. The benchmark rate went from near zero to 5.5%, the fastest tightening cycle in 40 years. Now think of it like this. Imagine you bought a house with a 5-year ARM, an adjustable rate mortgage. Your payment was $1,500 a month. 5 years later, your rate resets. Suddenly, you owe $3,800 a month, but your salary hasn't changed. And your house, instead of appreciating, is worth 40% less than when you bought it. You can't refinance. No bank will lend you more than the building is worth. You can't sell. Buyers know the math doesn't pencil out. You can't hold on. The debt service is crushing you. That is precisely the trap that $1.5 trillion in commercial real estate loans are walking into right now. The Mortgage Bankers Association estimated that, at current interest rates, approximately 40% of maturing office loans cannot qualify for refinancing. Not because the owners are reckless, because the arithmetic is broken. The income the building generates, the rent rolls, no longer covers the debt service at current rates. This is what analysts call refinancing risk. But let's call it what it really is, a slow-motion foreclosure wave. And unlike the 2008 housing crash, which detonated suddenly, this one is grinding forward quarter by quarter, building by building, city by city. Here's where this story stops being about finance and starts being about where you live. When office towers empty out, the first casualty isn't the landlord. It's the sandwich shop on the ground floor, then the dry cleaner, then the parking garage, then the coffee cart, then the gym. The entire ecosystem of urban commerce that depends on 50,000 daily commuters suddenly has no customers. And when those businesses close, the city's tax revenue evaporates with them. That's when the doom loop begins. San Francisco provides the starkest case study. Office vacancy in the city hit 37% in early 2025, the highest of any major American city, surpassing even Detroit in its worst years. Property tax revenues have fallen by nearly $1 billion annually. The city has had to slash budgets across every department. The MTA in New York, BART in the Bay Area, the CTA in Chicago. These transit systems were engineered to serve a daily ridership that no longer shows up. New York's MTA faces a multi-billion-dollar structural deficit. BART ridership is still running at roughly 50% of pre-pandemic levels. Without fair revenue, these systems cut services. When they cut services, fewer people commute. When fewer people commute, more offices empty. When more offices empty, tax revenues fall further. When tax revenues fall, the city cuts more services. Round and round it goes. Urban economists have a clinical term for this, the doom loop. But there's nothing clinical about watching a city slowly bleed out. The knock-on effects are severe. Reduced police and fire services, degraded infrastructure maintenance, rising vacancy rates that attract vandalism and disorder. Property crimes fill the vacuum that commerce left behind. The urban tax base, already strained, gets asked to carry more weight with fewer taxpayers footing the bill. Detroit's bankruptcy in 2013 was dismissed as an outlier, a Rust Belt city that industry had abandoned decades ago. But San Francisco is not Detroit. Chicago is not Detroit. These are alpha cities, economic engines, and they're showing the early warning signs of fiscal distress that, left unaddressed, look uncomfortably familiar. At this point, you might be thinking, fine, rich developers and coastal cities take a hit. What does that have to do with me? Everything. And here's why. The largest holders of commercial real estate debt in America are not Goldman Sachs. They are not Blackstone. They are not the big Wall Street banks you see on television. They're the regional and community banks. The 4,500 plus smaller institutions that collectively hold nearly 70% of all outstanding commercial real estate loans in the United States. These are the banks that hold your savings account, your business checking, your small business loan, your parents' retirement CD. They're the financial backbone of Main Street America. In March 2023, Silicon Valley Bank collapsed in 48 hours. Signature Bank followed. First Republic was seized. These were not subprime lenders running casino operations. SVB was the bank to the venture capital industry. It collapsed because its balance sheet couldn't handle the rate environment, a taste of the reckoning that CRE now threatens to deliver at vastly larger scale. The FDIC has identified over 60 banks on its problem list as of mid-2025. Independent analysts who have stress-tested regional bank portfolios against current CRE valuations put that number considerably higher. When a building that secures a $200 million loan is suddenly worth $40 million, the bank that made that loan has a problem that cannot be hidden in a footnote. But here's what most people don't understand. The pain doesn't just hit the shareholders. It hits the pension funds that hold bank equity. It hits the money market funds that are exposed to bank commercial paper. It hits the municipal bond markets that cities depend on to finance schools and roads. It hits the FDIC insurance fund, and by extension, your insured deposits, if enough banks fail simultaneously. The 2008 crisis was triggered by subprime mortgages packaged into securities that nobody truly understood. This crisis is more straightforward. It's loans on buildings that are worth less than the loans. The math is right there on the balance sheet. And unlike 2008, there is no complex financial alchemy to obscure it. Every policymaker, every urban planner, every real estate consultant is pushing the same solution: convert empty office space into housing. It sounds elegant. America has a housing shortage. America has an office surplus. Connect the dots. The reality is considerably messier. Office buildings were not designed to be apartments. The floor plates are too deep. The interior of a typical office floor is 60 to 80 feet from any window. Apartments need windows, natural light, individual plumbing stacks, HVAC systems designed for occupancy around the clock, not 9 to 5 shifts. The structural bones of most office towers are simply incompatible with residential use without full gut renovations that can cost $300 to $500 per square foot. That puts total conversion costs, after accounting for the discounted purchase price, at levels that often don't pencil out unless governments provide substantial subsidies. New York, San Francisco, Chicago, and Washington, D.C. have all launched conversion programs. Progress has been slow. The projects that are working tend to be older office buildings, pre-1980 construction with smaller floor plates, not the glass curtain towers of the 1990s and 2000s. Some buildings will be converted. Some will be demolished. Some will be repurposed as data centers, warehouses, or medical facilities. And some, perhaps more than anyone wants to admit, will simply sit vacant, dragging down surrounding property values, depressing neighborhood vitality, and rotting quietly on bank balance sheets for years. The real question isn't whether office to residential conversion is possible. It's whether it can happen fast enough and at enough scale to prevent the financial damage from compounding into crisis. Here is the prediction that most financial commentators are reluctant to make on the record, but that the data has been telegraphing for 3 years. The American city, as it existed in 2019, is not coming back. The concentrated commercial core, the central business district as the engine of the urban economy, is structurally obsolete for a large class of knowledge workers who have reorganized their lives around remote and hybrid work. This is not a pandemic anomaly. It is a permanent behavioral shift, confirmed now across 5 years of post-pandemic data. What comes next is a geographic rebalancing. Secondary cities, those with lower costs, more space, and stronger quality of life, are gaining ground. The Sun Belt has absorbed enormous population growth. The dense coastal metros are losing residents, tax base, and political influence simultaneously. Some of the major cities at the center of this crisis will adapt. New York has survived worse. Chicago has shown resilience across multiple economic cycles. But the adaptation will be painful, uneven, and slow. It will require writing down losses that banks and pension funds have every incentive to delay acknowledging. It will require policy interventions at a scale that current political environments make difficult. And it will almost certainly require some number of bank failures, municipal fiscal crises, and pension shortfalls that ripple outward from the towers themselves into the lives of people who never set foot in them. The $1.5 trillion time bomb is not a Wall Street problem. It is not a San Francisco problem. It is an American problem, and the clock has been ticking for years. If you want to understand how we got here in full, where the next fault lines are, and which institutions are most exposed, subscribe. Hit the bell, because this story is far from over. And if you believe that what happens on Wall Street eventually reaches Main Street, leave a comment below. Because the people who saw 2008 coming said the same thing. Nobody listened. Let's not make that mistake twice.